Today, we're going to decode one of the most fundamental mechanisms in the entire digital asset space, the Bitcoin halving. It's this pre-programmed economic event that really dictates the market's rhythm. So we'll explore its history, how it works, and its evolving role in the financial world. Let's get right into it.
I think this quote just captures the whole idea so well. It's this predictable, almost ceremonial event, but one with huge economic consequences. This isn't some random market swing. It's a core feature of Bitcoin's design, engineered right from the very beginning to control its supply.
So what is it, technically speaking? Well, the halving is a rule that's literally embedded in Bitcoin's code. It cannot be changed. Every time 210,000 blocks are mined, the reward that miners get for securing the network gets slashed by 50%. This is the engine that drives Bitcoin's monetary policy, making sure the creation of new coins slows down in a way that's totally predictable and transparent.
And this slide right here really highlights the fundamental difference between Bitcoin and the traditional currencies we use every day. You see, while central banks can decide to increase the money supply whenever they see fit, Bitcoin's supply is absolutely finite, and its issuance schedule is set in stone. This creates what we call digital scarcity, and it's meant to mimic commodities like gold. The halving is just the mechanism that enforces that scarcity, making Bitcoin deflationary by its very nature.
Okay, so we've established the theory. Now let's look at what has actually happened in reality. Because the halving isn't just some abstract idea, it's a recurring event that has historically shaped the market's 4-year cycles.
And as you can see, it has occurred like clockwork. From that very first event back in 2012, when Bitcoin was still this niche experiment, all the way to the most recent one in 2024, with Bitcoin now being a globally recognized asset. This predictable rhythm, well, it forms the backbone of how many people analyze its long-term market trend.
The data here really illustrates the historical pattern. If you look closely, after each of the first 3 halvings, Bitcoin entered a major bull market, and it reached a new all-time high within about 12 to 18 months. That supply shock, when combined with growing market attention, has consistently come before these periods of dramatic price growth. And of course, the data from this 4th halving cycle is something everyone is watching very, very closely.
However, and this is a really crucial point, we have to add a layer of nuance here. While the pattern of a post-halving rally has been consistent so far, the magnitude of that rally has actually decreased over time. Think about it. As Bitcoin's total market value grows, it requires exponentially more money to get those same eye-popping percentage gains. This trend of diminishing returns is a classic sign of a maturing asset, and it's a key thing to keep in mind for any long-term analysis.
And that brings us to, well, the most important disclaimer of all. While these historical patterns give us a really valuable framework, they are not a crystal ball. Every single cycle plays out in a completely unique economic and regulatory environment. The key here is to use history as a guide, not as some infallible predictor of the future. Now let's shift our focus to the group that is most directly impacted by the halving, the miners. I mean, these are the people and companies that form the backbone of the network, and this event completely changes their economic reality, literally overnight. This is the million-dollar question, isn't it? Miners invest huge amounts of money in hardware and energy to keep the network secure, and their main subsidy is programmatically chopped by 50%. So how does the system possibly adapt to prevent a total shutdown of the network's security?
Well, the network's economic model actually has 3 core ways of adapting. First, and historically the most important, is price appreciation. It's simple. If the value of each coin you earn doubles, the reduction in the reward is offset. Second, the halving forces what you could call an efficiency arms race. It weeds out the less efficient miners and really drives innovation in hardware and finding cheaper energy. And finally, as those block rewards get smaller and smaller, the transaction fees paid by users are designed to become the main incentive, making sure the network stays secure long into the future.
So to really understand the current cycle, we absolutely have to zoom out. You see, Bitcoin doesn't operate in a vacuum anymore. Its 4-year cycle is now intertwined with the entire global financial system, and that creates a much more complex dynamic than it had in its early days.
There are really 3 key forces at play here. First, global liquidity. Bitcoin has shown that it's highly sensitive to the monetary policies of major central banks. Second, the introduction of spot Bitcoin ETFs has created this regulated, accessible bridge for huge amounts of institutional capital, a factor that just didn't exist in any of the previous cycles. And when you put those 2 together, they point to an asset that's maturing, where its price action might become a little less volatile and more influenced by traditional macroeconomic forces. And that leaves us with the central question for anyone observing this market. The halving provides this predictable supply shock, a powerful rhythm that has defined Bitcoin's past. But now, that rhythm has to contend with the unpredictable tides of global finance and institutional money. The answer is going to define not just Bitcoin's future, but the evolving relationship between these new decentralized protocols and the traditional economic world.